Hello and welcome back to the Real Estate Roundup podcast. My name is Kobe Zinn, and I'm joined here today by my co-hosts Tony Flores and Andres Martinez, both real estate professionals here in the great state of Texas. How are you guys doing today?
Awesome.
Awesome. Have a
Yeah,
good week.
it's been a good week, hasn't it? So we did have you guys are following our show for a while. We did have a 1 week hiatus because as real estate professionals we are busy working with our clients, but we are back today. And today we're going to be talking about basically answering a question that comes up commonly when it comes to clients buying or owning their homes, and that is what is actually included in the monthly escrow payment that you have to make to your escrow company, right? What's included, what's not included, and actually how to afford your home moving forward, especially as we kind of go into a little bit tougher market here. But we'll get started right here, right? So we'll just dig right on in. So, Tony, why don't you give us an idea of, from your understanding as a client who's buying a home, what is actually included in the monthly escrow payments that they have to pay every month after purchasing the home?
Yeah, so this is a great topic. What is escrow? What does that mean? So there's when you see some mortgage calculators online, if you say, okay, I'm looking at a house that I think my price range is, say $400,000. Okay, so then you can look at mortgage calculators and it says your mortgage payment would be this. Okay, but that's not all that's going to be included in a true mortgage payment for many people. So what they have is what's called, of course, the total mortgage payment, which goes directly to the mortgage company and has no outside others people that it's going to. It's going to be the principal. That's the amount of that's a principal reduction. The amount of that's going to reduce the total balance of the loan, and then the interest. Now, towards the beginning of the loan, your interest is going to be like this compared to your principal is going to be like this. So as you make payments, your interest is going to go down, your interest payment is going to go down, and your principal pay down is going to go up. Okay, so that's one of the things. So even though the monthly payments are going to stay the same, your monthly payments are going to stay the same, the amount that's applied to going directly to pay off your home is going to be paid off much quicker at the end of the loan as it is at the beginning of the loan. Is very, very, it's kind of a sliding scale. Okay, so that's just going to the mortgage company for their pocketbooks. So and that's of course based on interest and the term of the loan. So what else is besides that? So you could have the MIP, which is the mortgage insurance premium. If you have a balance that's less than, you didn't put 20% down, there's additional cost of that. And then the other part is insurance for the home insurance. A lot of times the mortgage company wants to include that, and then the taxes as well. So we call it PITI, just kind of as for short: principal, interest, taxes, and insurance. And then you might have mortgage insurance premium. And I'll let Andres I'll let him talk about that. But that's a lot. I mean, and so when you see the mortgage calculators online, you're not going to get the full picture of what a true payment would be.
Yeah. Yeah, and I'm glad you brought up that one point of, the mortgage payment and the interest payment, how it's a sliding scale, because for a lot of people, if they're really doing a lot of research, they don't really understand kind of how that works. That could be really confusing for a first time home buyer or just somebody buying a home. Like, why is why is my interest so high? My payments are so low. This is going to take way more than the time than we thought it was, right? But it actually works in a sliding scale. So it's a little bit different, right? If you look deeper into the details of how that works. So I'm glad you were able to clear that up. And then the same thing over to you, Andres. We were talking a little bit before the show as well about, some of the issues that come up with people who are not understanding what goes into monthly escrow payments, and also how to potentially even reduce your monthly escrow payments as well. So just from what you're dealing with as far as clients that you're talking to and helping on a daily basis, what are some of the common misconceptions that they have about the monthly escrow payments and how all of that works?
So one thing I know we were just talking about the sliding scale. One chart that could be used for that, if some people are more visual, the amortization chart. There is an amortization chart that'll let you know how much money is being applied to your principal. But as far as people's like misconceptions or questions or concerns is, um, when we present a payment calculator or a monthly payment to them, they think that after that they still have to pay for taxes and they have to pay for their insurance premium. So after 2008 and the epic collapse of the mortgage industry, there has been some guidelines that have been put in place to protect the consumer. So before you would pay your principal and interest, so you would pay your mortgage payment, and then separately you would send out your own taxes, and then you would send out your insurance. So after 2010, there was a system in place where everything is represented in your monthly payment, and that's where you have your escrow and you have your principal and interest. A lot of people do not understand that everything's already included. So the reason we want in the mortgage industry, we want it to be represented. We don't want surprises. Now, could something change as far as your escrow or your payment? So, guys, the only time your payment changes as far as your monthly payment, it's never going to be your principal and interest. What's going to change is your taxes. So, as you live in a home, hopefully the 3 to 6% gains that usually happen in a healthy market, then if your house is worth more, then you'll be paying more taxes towards your property. But sometimes they might be minimal growth of 1%, 3%. No one can ever guarantee that your property values are going to increase. But anytime your property value is worth more, you will pay a little bit more, or you will allot a little bit more escrow because your taxes will go up as far as your property value.
Yeah. So that's one of the ways that, or one of the reasons why, if people are paying off their escrow, that could potentially go up, is if if their property values went up and the taxes increase. And just from kind of your experience, what is usually that increase? Is it like a huge amount or a little bit every month?
So, just a little bit of feedback, guys. So, taxes, right? Historically, our property values in a very, very good year, it might go up like 3%, right? So, we might see a shift of like, depending on how much your property went up in value, but usually it's like 40, $60. Well, after COVID, property values skyrocketed. They went up 28, 22, 23%. I've seen something as even 18%. So those numbers were astronomical. So people's monthly payments went up for $500. So what has the state of Texas done for that? In During COVID 2020, our homestead exemption was only $25,000. Then thereafter, they changed it to 40,000. As of last November, that homestead exemption is $100,000. Therefore, making people's monthly payments, people actually reduced their escrow this year. So one thing you have to know, the first thing your realtor or your real estate professional has to make you aware when purchasing a home, you made a great decision. They brought great value. They found the home that your family is going to live in. We all love the home. But how a real estate agent or professional brings more value is by delivering the homestead exemption. That homestead exemption will help offset your taxes, therefore saving you money. So the value of a realtor or a real estate professional moving forward, uh, if he's able to give you information on how to get your homestead exemption, he keeps um, your relationship with that professional or real estate agent keeps bringing you value throughout the life of you uh, owning that property.
Yeah, that's actually a really good way to look at it, right? Because if your real estate agent is able to help you with that, it's not just kind of helping you with the transaction. It's that value is extended throughout the entire time that you actually own the property as well. So it's a totally different way of looking at things, and I think it's really valuable as well. So another question that I think comes up a lot now, especially in the market, are people are kind of considering when they're seeing whether or not they want to buy a house, whether they should even consider the actual home price or should they just be looking at the monthly payments. So, Tony, kind of going to you, what would you suggest to people? Should they be looking at just simply that monthly escrow payment to see whether or not they can actually afford a home, or should they actually be considering the value and the price of the actual home being sold? Or does that not matter as much as paying the monthly payments off?
Yeah, I think for the most part, when people make decisions on buying, they're not really thinking about when it will be sold. They're just considering the fact that is this affordable to me? Is this where I want my family to be living, or does this fit the lifestyle that I'm in right now? If there's not a family unit at the time. So it is something that is to be considered down the road. Hey, is there potential for this property to appreciate in value? I think that is a great thing to try to figure out. And for the most part, if someone's being a little bit discerning about where they want to live, more than likely they're probably going to pick a good spot. Okay, so the other thing that they can consider is if there happen to be adjustable rate mortgages, which they had a while back, and there's some of them are coming back. They're getting popular. It's like, okay, this is affordable to me now, and I was qualified on the higher interest rate, but I've got to continue to keep my payments. And we did discuss this before, but don't go overextending yourself on other things a year down the road, because now, okay, your $500 car payment today now is next year it's you traded in, now you got a $630 payment now. Okay, but then that adjustable rate mortgage might change as well. So now your adjustable rate mortgage was based on your expenses. If you didn't get a raise, then where's that extra money coming from? Because your car payment went up and now your house payment went up. So those are some of the things to watch out for, to keep in mind as well. So the other thing that I didn't mention earlier, as far as house payments, the other thing that could be added on as well, depending on where the house is selected, could be an HOA payment as well. Some are $40 a month, some are $150 a month. So it just kind of depends on that as well. And the reason why the mortgage companies want to escrow your payments, they want to essentially kind of be the gatekeeper with how much money is going to be going to your obligations. If the insurance doesn't get paid, for instance, then if you run out of house insurance, and there's a crazy, unavoidable, unpredicted storm, something comes down and your tree falls down on your house, and now you got a big old hole in your roof. Now who's gonna pay for that? Are you gonna pay for it out of pocket? Well, you cancel the insurance, so then how's that gonna get covered? So what this allows the mortgage company to do is ensures that those payments that are going to them, they're going to be spreading them out. They're going to be sending them to the insurance company. They're going to be paying their taxes, because if you don't pay your property taxes, again, now then the taxing authority could come and sell the house if worst comes to worst. So they are trying to make sure that everyone's getting paid and everything's moving forward with your payments. That's why they love to have your monthly payments escrowed, and everyone gets covered. All the bills are paid as far as what needs to be paid for the house.
Yeah, and it's important to remember that the mortgage company has an interest in the home that you own as well. So that's why they're taking these precautions to make sure that, really, to make sure that you're able to make the payments, and you're able to get everything covered, and nothing drastic happens, and they don't necessarily want you to get foreclosed on, or the home to be sold.
Right.
Well,
And when foreclosed,
if the house gets blown down by a storm and it's not habitable, are you going to pay that payment?
all right.
That's a big risk for the mortgage companies.
So they're protecting their investment. They're the one that put up all the money to buy it at the front. They put up all their money. They got the money to the title company, and they that's their asset, as well as it's yours. But they're the one that's forked up the money up front, so they got to protect it and have different ways to do that. So that's what escrow does. It protects them, and really at the end of the day, it does protect the homeowner as well, because they don't want anything bad to happen to their home.
Yeah, exactly. And really, kind of the other thing that comes to mind is there are certain programs, or I guess certain ways that people can accelerate their mortgage payments out there. I don't know if you guys are familiar with some of these things that are out there. What is your suggestion on the usage of that? Is there any benefits to accelerate your mortgage payment over the years, or is that something that maybe you should take a little bit more time to consider before using it? Andres, you can go ahead and answer that. And
So if you pay your payments every 14 days, um, if you do half of your payment every 14 days, essentially there's some months that have like 31 days, and you will pay an extra payment if you do them every 14 days, not every 2 weeks, every 14 days, because there is months with extra days. Essentially, you pay an extra payment. That's one way to do it. But my recommendation would be like, if you ever have extra money, just apply it to the principal. You have a little bit more control over that. A lot of people are very comfortable just doing their monthly payment. So getting them out of their comfort zone could be risky. So the best thing to do is just, if you have a little extra money, pay it towards the principal. When you do an extra payment, don't do it an extra payment. Pay that amount towards the principal. Therefore, there's no escrow. Uh, it all gets applied to your balance, and that's what, when we're trying to um, kind of make a dent into your overall balance, paying off to the principal, if it's anything extra, is the best route as far as for that.
If you're able to make one extra mortgage payment per year, and a lot of times people get paid, in I think August, a lot of people are getting 3 paychecks, as August 2nd is the first Friday of the month, and there's another 2 weeks later, and then there's 2 weeks later. So if they made half of the mortgage payment on that month, what they'll do, I'll give you an example. I have a client that showed me their mortgage statement. They bought their house just like 3 years ago. They're making roughly almost a $4,000 a month payment, and what their principal payment was out of that $4,000 was about $200 for that particular month. So imagine what making an extra $4,000 payment will reduce their principal by. So they're making essentially $2,400 a month, or $2,400 for the entire year, but now they're making one chunk payment of $4,000, and they can make $2,000 in half a year and $2,000 the second half of the year. But that's basically making, and kind of like making 3 years worth of payments with one extra payment per year. So that's how it is. It will make a 30-year mortgage. Obviously, it varies by interest rate and terms, but could make a 30-year mortgage closer to a 15, 16, 17-year mortgage. So, yeah, that's extra principal pay down. Make sure you contact your mortgage company to see, that you tell them, direct them, say this, I want it all to principal, and it will pay off your mortgage faster.
And get a receipt, or if you write a check, I know people don't write checks anymore. Make sure it's documented. I do it on my online portal. If I ever want to do an additional to the principal, I could do it every month. Even if I wanted to do like an extra $300.
Yeah.
It has my payment, escrow, and then it says additional payment principal. So
Yeah.
as long as I can see it documented that it's going to the principal, I think you're going to be better off knocking off some of those payments. So some people say if you do an extra payment, you could probably knock off 7 years. But the more aggressive, the more years you're able to reduce.
So makes a big difference, right? Turning a 30-year mortgage 15, 16, that's half the time. So never know what you're going to learn when you listen in and tune into the Real Estate Roundup, right? So some valuable tips here. But no, I think it was a great episode today. I think we covered a lot of good information that can help people answer a lot of questions about their monthly escrow payments. And if you guys are interested in working with a real estate professional, make sure to check out the description of this podcast down below in the show notes. So that way you can reach out directly to either Tony or Andres, and they will be able to help you out with your real estate needs. You can see how much information they got and how much value and knowledge it can bring to the table just by listening to these shows. So just imagine what it's like working with them, right? Probably a lot, a lot more of this. So thank you guys, and thank you for tuning in. And we'll see you in the next episode of the Real Estate Roundup. Take care.
Take care.